Welcome to the deep dive. In today's fast-moving business world, the pressure to not only sell well, but also manage costs effectively is, well, it's relentless. It's a constant balancing act to stay competitive.
Absolutely. And today we're digging into some really powerful techniques designed to help businesses take a more strategic and intelligent approach to cost management.
Exactly. We've got a fascinating exploration lined up looking at specialist cost management strategies. Our goal today is to kind of break these down for you, providing a clear understanding of each and, crucially, how they can lead to, healthier profits and a more sustainable business overall.
Yeah, we're going to focus on three key methodologies. First, we'll unpack target costing, which is a way of thinking about product costs right from the initial design phase, really driven by what the market will bear.
Okay.
Then we'll explore the theory of constraints, a powerful lens for maximizing efficiency in your operations by focusing on what actually limits your output. And finally, we'll delve into environmental management accounting, which is increasingly vital for understanding and managing our impact on the planet alongside our financial performance.
Okay, sounds great. Let's dive right into target costing then. In simple terms, what's it all about?
At its heart, target costing is about determining the absolute necessary production cost for a product, given its specific features and the level of quality customers expect, so that you can achieve your desired profit margin at the price you anticipate selling it for in a, competitive market.
So hang on. Instead of figuring out what it costs you to make something and then adding a profit,
Yeah.
you're starting with the price the market will accept and working backwards. Is that it?
Precisely. It's a proactive strategy that kicks in right at the very beginning of product development. This is a real shift from the traditional cost-plus model,
Yeah, the old way.
Right, where you calculate your costs and then just add a markup to arrive at your selling price. Target costing completely flips that whole approach on its head.
Okay, I get the concept. So how does a company actually go about implementing target costing?
Okay.
What are the practical steps involved?
Well, the process really starts with a fundamental change in how the organization thinks. The first step is reorienting the entire company culture to be truly driven by market prices and customer needs.
A culture shift first. Okay.
Yeah, it's about understanding that the market dictates what you can charge, not just what it costs you to produce.
That makes sense. You have to know what customers were willing to pay before you even start designing. So what comes next?
Step 2 is all about getting a deep understanding of those market requirements. It's crucial to be laser focused on the customer here and really understand what they value in terms of design, functionality, and their underlying needs. This applies whether you're developing a brand new product or just improving existing ones.
So customer insight is absolutely key. What follows that?
Step 3 is establishing the market-driven target price. Now, this isn't just a shot in the dark. It requires a careful analysis of things like your desired market share, what your competitors are charging,
Right.
the sensitivity of demand to price changes, and your overall business strategy. Once you have that target price, the next part of step 3 involves determining the anticipated production volume you think you can achieve at that price,
Okay.
and then establishing your target profit margin for each product, always keeping your long-term financial goals in mind, of course.
Okay, so you figured out your target selling price and your desired profit. Now you can actually calculate your target cost. Right?
Exactly. Step 4 is determining the target cost by simply subtracting your desired profit margin from that market-driven target price. And at this point, it's important to start breaking down that overall target cost and allocating it to the different subsystems and components of the product. These sort of sub-targets then become the responsibility of specific design teams or individuals.
Yep.
And a crucial part of this step is ensuring that those allocated target costs still allow you to meet the customer requirements you identified earlier. That's key.
So the cost targets are set. What are the subsequent steps to actually, achieve them?
Step 5 is about putting the target costing process itself in place. This involves clearly defining who will be involved, what their specific roles and responsibilities will be, and the tools and techniques they'll use throughout the entire process.
Setting up the framework.
Exactly. Then, step 6 is where the real innovation and problem solving come in. It's about brainstorming and thoroughly analyzing different ways to reduce costs, both in the actual design of the product and in how it will be manufactured at every stage of its development.
Okay.
This also involves creating detailed cost models for each of these design concepts and alternatives so you can make really informed decisions.
Sounds like a very iterative and analytical process. What's the final step then?
Step 7 is all about actively using specific tools and techniques to bridge the gap between the cost as projected by those cost models and the initial target cost that was established.
closing the gap.
Precisely.
Thanks,
This is where methods like value engineering and value analysis become critical for identifying opportunities to reduce costs in both the product's design and the production processes without sacrificing customer value.
Value engineering and value analysis.
Well,
Okay, we should definitely circle back to those. But first, what are the core principles that sort of underpin the success of target costing?
there are several fundamental principles at play. Firstly, the absolute necessity of teamwork and close collaboration across different functional areas within the organization: R&D, marketing, production, finance, purchasing, everyone.
Mm.
Secondly, a focus on driving down the total cost of the product over its entire life cycle, not just the initial manufacturing expenses.
Whole life cycle. Right.
Thirdly, a strong emphasis on the product design stage, recognizing that this is where the vast majority, maybe 80% or more, of a product's costs are actually locked in. Wow, okay.
And finally, a holistic view that considers all stages of the value chain, from your raw material suppliers all the way through to after-sales service and support. It's about the entire ecosystem.
So it's a really integrated way of thinking, isn't it? What are the major advantages then, the payoffs, of adopting target costing?
The benefits can be quite significant. It really fosters a company-wide commitment to innovation, both in the products themselves and the processes used to create them, pushing teams to find truly creative solutions.
Okay.
It helps to tightly align your cost management systems with your overall manufacturing strategy and allows you to proactively identify market opportunities for genuine cost savings, rather than just, chasing the absolute lowest possible cost blindly.
So it's forward-looking.
Very much so.
Yeah.
It ensures cost management is planned well in advance of actual production. It also builds greater cost awareness among employees and encourages stronger, more collaborative relationships with your suppliers.
That supplier relationship piece seems important. It is. Furthermore, it drives a focus on activities that truly add value for the customer and can help reduce the time it takes to bring a new product to market. And crucially, because it's market-driven, it keeps your costs aligned with what customers are actually willing to pay for the product.
Those all sound like pretty compelling reasons to use it. But are there any potential downsides or, let's say, challenges with target costing?
Yes. Like any strategic tool, there are potential drawbacks to be aware of. The product development timeline can sometimes be considerably extended, as design teams go through multiple rounds of iteration to meet what can be a very challenging target cost. It also necessitates the development of very detailed and accurate cost data, which, frankly, can be expensive and time-consuming to gather and analyze.
Right, the data burden.
Exactly. And there's a risk, you have to watch out for this, that an excessive focus on cost reduction might lead to the use of cheaper components that ultimately compromise the product's quality or longevity.
Yeah, cutting corners, potentially.
Potentially. And because it relies heavily on predictions about future market conditions and sales volumes, it inherently involves a significant degree of forecasting and estimation, which, as we all know, can sometimes be unreliable.
So it's not a guaranteed success then. It sounds like strong leadership and effective teamwork are absolutely crucial to navigate these challenges.
Absolutely. It really requires a capable team leader who not only has a deep understanding of the design process, but also possesses strong interpersonal skills and a firm commitment to adhering to both time and budget constraints. Building a cross-functional team with diverse expertise, design, engineering, manufacturing, marketing, finance is also essential for successful implementation. You need all those perspectives.
Earlier, you mentioned value analysis and value engineering in the context of target costing. Could you elaborate a bit on what these techniques involve?
Certainly. Value analysis is a systematic and structured approach to cost reduction that examines the materials used and the production design of an existing product.
Existing products, okay.
Right. The goal is to identify potential modifications and improvements that can be made to reduce costs without diminishing the product's value or functionality from the customer's perspective.
And value engineering.
Value engineering, on the other hand, applies the same fundamental principles as value analysis, but it's focused on new products.
For new stuff.
Exactly. It's about proactively designing the product and its production process in a way that avoids unnecessary costs right from the outset, before production even begins. Both techniques essentially involve a very thorough and critical review of the product and how it's made, asking, what value does this feature or process step actually add?
And what kind of questions do teams typically ask when they're conducting value analysis or value engineering? What are they looking for?
They delve into a whole range of fundamental questions, like, can we completely eliminate any of the product's functions without impacting its core purpose?
Right.
Can we perhaps reduce the required level of durability or reliability if customers don't actually need or value that higher level? Can we simplify the overall design to make it less complex and therefore less expensive to produce?
Makes sense.
Can we design the product in a way that makes it easier and more efficient to manufacture? Are there alternative materials or components that would perform just as well but at a lower cost?
Right, substitution possibilities.
Exactly. Can we combine any of the manufacturing steps to streamline the process? Can we tap into the expertise of our suppliers? This goes back to that relationship point to identify more cost-effective solutions. And fundamentally, just asking over and over, is there a better way to achieve the same outcome for the customer at a lower cost?
It sounds like a really rigorous examination of every single aspect of the product in its creation. And you mentioned earlier, target costing also emphasizes the importance of considering the entire value chain, doesn't it?
Absolutely. Engaging everyone involved in the value chain from your raw material suppliers and component manufacturers all the way through to your distributors and after-sales service providers, involving them in the target costing process is crucial.
Why is that so crucial?
Well, it helps build strong long-term relationships and achieve mutual benefits in terms of cost reduction. If your supplier can help you design something cheaper, maybe that means more volume for them. It often requires a significant shift in mindset, particularly for product design teams, as it necessitates constant collaboration and open communication across many different departments and external partners, which can be quite different from more traditional sort of siloed ways of working where design throws it over the wall to manufacturing.
Right, breaks down those silos. Okay, that gives us a really solid understanding of target costing. Let's shift gears now and move on to our second strategic cost management technique. The theory of constraints, or TOC. What's the central idea behind this approach?
The theory of constraints, or TOC, is essentially a production management philosophy. It focuses on maximizing the overall throughput of a system throughput, meaning the rate at which the system generates money through sales.
Okay, maximizing throughput, how?
By identifying the bottlenecks, the factors that limit the system's output, and then managing those bottlenecks effectively. The core principle is that the rate at which your entire system generates money is determined by its constraints, its bottlenecks.
Right.
Therefore, to improve overall performance and profitability, you need to focus your improvement efforts squarely on those constraints.
Okay, bottlenecks and non-bottleneck resources. What's the crucial distinction we need to understand there?
A bottleneck resource is any resource whose capacity is less than the demand placed upon it. It's the tightest point, what restricts the overall flow and output of the entire system.
Like the narrowest part of a pipe.
Exactly. A non-bottleneck resource, on the other hand, has more capacity available than is currently being used. Now, a key insight of TOC is that non-bottleneck resources should not be utilized at 100% capacity simply for the sake of keeping them busy or hitting some local efficiency target. If doing so just leads to a buildup of excess inventory before the bottleneck, that excess inventory represents tied-up capital and doesn't actually increase the overall rate at which you're generating money through sales, which is the ultimate goal of TOC.
Right, it just creates a backlog of work in progress, ties up cash, and doesn't help the system's overall output.
So how does TOC define and measure operational performance then?
TOC uses three key operational measures. First, there's throughput, T. This is defined as the rate at which the organization generates money through sales. It's calculated as sales revenue minus unit-level variable expenses, typically just direct materials in a pure TOC view, all divided by time.
Okay, sales minus truly variable costs. Exactly. And it's important to note that in TOC, direct labor is often considered a fixed operating expense within a specific relevant time frame, not a variable cost per unit.
Interesting distinction. What are the other two measures?
Second is investment. I. This represents all the money that's tied up in the system. Think facilities, equipment, raw materials, work in progress, finished goods inventory, basically, the balance sheet assets needed for production.
Got it. And the third?
Third is operating expense, OE. This is all the money the organization spends in order to turn investment I into throughput, T. This includes direct labor, salaries, utilities, rent, basically all costs other than those truly variable unit-level expenses included in the throughput calculation.
Throughput, investment, operating expense, TI, and OE. And based on these three measures, what are the primary management objectives according to TOC?
The objectives are quite clear and directly linked to those measures. The goal is always to increase throughput,
More money coming in,
minimize investment,
less money tied up.
and decrease operating expenses.
Lower running costs. Makes sense. So how does an organization actually go about improving its performance by applying the theory of constraints? Is there a process?
Yes, Eliyahu Goldratt, who developed TOC, outlined a very practical 5-step focusing process for continuous improvement.
Okay, what are the steps?
Step 1 is to identify the system's bottlenecks. Find out what is actually limiting your overall output. Where is the constraint?
Find the bottlenecks. Step 2.
Step 2 is to exploit the bottlenecks. This means ensuring that the bottlenecks are being used as effectively as possible. Don't let them sit idle. Make sure they're working on the right things. This involves ensuring they run at maximum capacity on the most profitable products based on throughput per bottleneck minute.
Squeeze the most out of the construct. What's step 3?
Step 3 is to subordinate everything else to the decisions made in step 2. This means the pace of all non-bottleneck activities should be aligned with or governed by the capacity of the bottleneck.
Don't let the faster parts run ahead.
Exactly. There's no benefit in having other resources working faster than the bottleneck can handle. It just leads to more inventory piling up before the constraint, increasing investment, and potentially operating expense without increasing throughput. Everything marches to the beat of the bottleneck drum.
Okay, subordinate. Step 4.
Step 4 is to elevate the system bottlenecks. This involves taking actions to actually increase their capacity or efficiency.
How do you do that?
Well, it could mean investing in a new, faster machine, providing additional training to the operators working on the bottleneck, improving maintenance, maybe even redesigning products or processes to reduce the load on the bottleneck resource. It's about breaking the constraint.
Invest to improve the bottleneck. And the final step.
Step 5 is essentially don't stop. Repeat the entire process. Because once you successfully elevate one bottleneck, another part of the system might become the new limiting factor, the new constraint.
So it's a cycle.
It's a cycle of continuous improvement, always focused on identifying and managing the current constraint to improve overall system performance.
That's a very clear and iterative approach to process improvement. Our material also mentions something called the throughput accounting ratio. What information does that give us?
Right. The throughput accounting ratio, or TA ratio, it's calculated by taking the throughput per bottleneck minute for a specific product
Okay.
and dividing it by the factory cost per bottleneck minute. And factory cost here is essentially your total operating expense divided by the total available bottleneck minutes.
So throughput per minute divided by cost per minute, specifically for the bottleneck.
Yes. A TA ratio greater than 1 suggests that, from a TOC perspective, that particular product is generating more throughput relative to the cost of consuming the bottleneck resource's time than the average cost per minute of that bottleneck.
And how is that useful?
It can be a useful metric for making decisions about product mix when you have a clear bottleneck in your system. You generally want to prioritize producing products with a higher TA ratio as they contribute more towards covering your overall operating expenses per unit of the constrained resource used.
Okay, helps prioritize what goes through the bottleneck. What are some of the general advantages that organizations can experience by adopting the principles of TOC?
Well, properly implemented, TOC can lead to a number of significant benefits. These often include lower levels of inventory, especially work in progress, more productive use of those critical bottleneck machines, shorter overall lead times for production, greater flexibility to respond to changes in customer demand.
Faster response.
Yeah, improved customer service due to more reliable delivery times, a more optimized product mix that maximizes profitability given the existing constraints, and ultimately that can lead to stronger relationships with customers because you're delivering what they want when they want it.
So it's pretty good. And what about the potential drawbacks or limitations of using TOC? Are there any criticism?
Yes, there are some potential limitations and criticisms. One is that its primary focus is often seen as being on the short term, maximizing throughput within the existing constraints. Some argue this is less strategic than approaches like activity-based costing, which can provide a more detailed long-term view of costs across all activities.
Short-term focus, okay.
Some critics also suggest that its strong emphasis on sales volume and throughput might sometimes overshadow the importance of product quality, unlike methodologies like Total quality management, TQM, which put quality first,
Volume over quality.
potentially, if not managed carefully. There's also a risk that by focusing so intently on specific bottlenecks, you might lose sight of the interconnectedness of the entire system, optimizing one part at the expense of the whole, though the subordination step is meant to prevent that.
Right.
It's often characterized as a push system of production, meaning you produce based on forecasts or schedules and push it towards the bottleneck, which is different from the pull system of just-in-time JIT, where production is triggered by actual downstream demand.
Push versus pull.
The effectiveness of TOC can also be limited if it's not applied consistently across the entire supply chain. A bottleneck might just shift to a supplier or distributor. And finally, some argue that its treatment of operating expenses, particularly labor, as largely fixed in the short term, can be an oversimplification of the complexities of real-world cost structures where some labor might be more variable.
Okay, that gives us a good, balanced overview of the theory of constraints and its implications for managing production and costs. Let's now turn our attention to our final technique for today. Environmental Management Accounting, or EMA. What exactly does EMA entail?
Environmental Management Accounting, EMA, is essentially the process of identifying, collecting, analyzing, and using information, both financial and non-financial, that's important, that is relevant to an organization's environmental performance.
Okay, focusing on environmental performance data. Why?
Well, the primary goal is to inform internal decision-making. It helps businesses to better understand and manage their environmental costs and impacts. Ultimately, the idea is to lead to both improved environmental performance and enhanced economic efficiency. It's about integrating environmental considerations into routine business management practices, not treating it as some separate, isolated issue.
Got it. What are some of the key factors that have led to the growing importance and adoption of EMO in recent years? Why now?
Several significant factors have really pushed EMA forward. Major environmental disasters, unfortunately, have certainly raised public awareness and put significant pressure on companies to be more environmentally responsible.
Yeah, the public scrutiny.
Definitely. International initiatives and agreements like UN goals have highlighted the global importance of sustainable practices. Regulatory requirements related to environmental protection are becoming much more stringent and widespread pretty much everywhere.
More rules.
And they often carry significant penalties for non-compliance. And perhaps most importantly, there's a growing societal expectation for businesses to operate in an environmentally sound manner. Consumers are increasingly aware of issues like carbon footprints, and that's influencing their purchasing decisions. Investors, too.
So, pressure from multiple angles. What kind of information does EMA typically deal with? Is it purely financial, dollars and cents, or does it encompass other types of data as well?
EMA deals with two primary types of information: physical and monetary.
Physical and monetary. Okay.
Physical information includes data on the quantities of resources used. Think energy consumption in kilowatt hours, water usage in gallons or liters, raw materials in tons or kilograms. It also tracks data on waste generated, emissions released into the air and water, and other environmentally related flows. It's about the physical stuff.
The actual flows of materials and energy.
Exactly. Monetary information, on the other hand, focuses on the costs associated with environmental activities like the cost of running pollution control equipment, waste disposal fees, environmental taxes. It also looks at potential savings that can be achieved through environmental improvements, like energy efficiency, saving money, and even potential earnings that can result from environmentally friendly products or services, sometimes called green premiums.
Right. Costs, savings, and earnings. Now, environmental costs themselves can be categorized in various ways. Let's start with a general distinction between internal and external environmental costs. What's that about?
Okay. Internal environmental costs are those that are directly incurred by the organization itself and typically affect its financial performance. They usually show up somewhere in the income statement or impact assets liabilities.
Like what?
Examples include the costs of waste disposal, the operation and maintenance of pollution control equipment, environmental permits and licenses, things like that. They are costs the company pays directly.
Okay, the company's direct costs. And external.
External environmental costs, in contrast, are those costs that are borne by society as a whole or by third parties and are not directly reflected in the company's own financial statements.
Yes.
These include things like the health impacts on communities from air and water pollution caused by the company, or the degradation of ecosystems, loss of biodiversity, climate change impacts. These are real costs, but traditionally, the company didn't pay for them directly.
The costs society bears.
Right. But there's an increasing trend, however, towards internalizing these external costs through mechanisms like carbon taxes, emissions trading schemes, stricter regulations, and liability laws. This makes companies more directly financially accountable for their broader environmental impacts.
Okay, making companies pay for their pollution. There are also different classifications of environmental costs based on various frameworks mentioned in our source. Could you touch on some of these ways of slicing and dicing environmental costs?
Certainly. One common way to categorize environmental costs is based on their nature and visibility within standard accounting systems. You have conventional costs, which are the standard costs of inputs like raw materials and utilities. Reducing consumption here saves money and often has environmental benefits, but they're tracked anyway.
Standard input costs.
Then there are potentially hidden costs. These are often lurking within general overhead accounts and might not be easily identifiable as specifically environmentally related unless you look closely.
Like what kinds of hidden costs?
These can include upfront costs, like environmental impact assessments before a project, or back-end costs like decommissioning or site restoration, or ongoing regulatory costs like monitoring, reporting, and permitting.
Okay, harder to spot in the overhead pool.
Exactly. Then you have contingent costs. These are future costs that may or may not be incurred depending on future events. Think potential fines for environmental violations, the costs of cleaning up accidental spills, or future liabilities under changing regulations.
Possible future costs.
And finally, there are relationship and corporate image costs. These are less tangible, perhaps, but still significant costs associated with stakeholder perceptions of the company's environmental performance.
How do you measure those?
It's tricky, but you can see it in the cost of producing environmental reports, the effort spent on community relations, or, negatively, the impact of a bad environmental incident on brand reputation, customer loyalty, or even employee morale. Think of major oil spills and the long-term image damage.
Right, the reputational hit. That's one framework. What about others?
Another useful classification framework borrows from the traditional cost of quality model. From this perspective, environmental costs can be seen as falling into 4 categories, similar to prevention, appraisal, internal failure, and external failure in quality management.
Okay, how does that apply to environment?
You have environmental prevention costs. These are costs incurred to prevent environmental damage from occurring in the first place. Think investing in cleaner production technologies, designing products to be less polluting, or training employees on environmental procedures.
Preventing problems. Makes sense.
Then, environmental appraisal costs. These are costs associated with monitoring and verifying environmental performance and ensuring compliance. Examples include environmental audits, site inspections, water or air quality testing, and monitoring activities.
Checking and measuring.
Third, environmental internal failure costs. These result from environmentally related activities or waste that are produced but not discharged into the environment. For instance, the costs of treating waste before disposal, operating pollution control equipment solely to meet internal standards, or recycling scrap material generated internally.
Dealing with waste internally.
And finally, environmental external failure costs. These are the costs incurred after waste or pollution has been released into the environment. This is often the most costly category. Think cleanup costs for contaminated sites, fines for exceeding pollution limits, compensation paid for environmental damage, loss of resources through pollution, and the associated reputational damage.
Cost after pollution happens.
Exactly, and this quality cost framework often emphasizes the importance of tracking these costs, maybe as a percentage of sales or operating costs, to really highlight their significance to management.
That seems like a powerful way to frame it. Any other classifications?
One more mention is from the UN Division for Sustainable Development. It offers a slightly simpler classification that distinguishes between 1, costs incurred specifically to protect the environment, like investments in pollution prevention technologies or conservation efforts, and 2, the costs associated with the inefficient use or wastage of resources.
Wasted resources.
Yeah, like the cost of raw materials that end up as waste or the cost of energy lost through inefficient processes. This classification really highlights the potential for win-win scenarios where reducing inefficiency saves money and benefits the environment.
Okay, so quite a few different lenses through which we can view and categorize environmental costs. What are the main phases involved in actually managing these costs effectively within an organization once you start thinking about them?
Generally, you can think of 3 key phases in managing environmental costs. First, you have to identify them. Second, you need to allocate them appropriately. And third, you need to find ways to control them. Identification, allocation, and controlling.
Identify, allocate, control. Okay. Let's delve into identification and allocation first. What are some of the primary techniques that organizations use to actually find these environmental costs and then assign them to the right products or processes?
Several techniques are particularly valuable here. Input-output analysis is one. This method systematically tracks the flow of materials and energy entering an organization and compares it with what leaves as products and waste.
Balancing the inputs and outputs.
Exactly. Any discrepancies can highlight material losses or inefficiencies that have both environmental and cost implications. It helps make the invisible visible.
Okay, what else?
Flow cost accounting is somewhat related. It specifically focuses on tracking the quantities and costs of materials as they move through the different stages of the production process, really zeroing in on where material losses occur and what those losses cost the company, including disposal.
Tracking material flows and their costs.
Yes. Then there's life cycle costing. This takes a much broader perspective. It aims to consider all the costs and revenues associated with the product or service throughout its entire lifespan.
From cradle to grave.
Precisely. From raw material extraction through manufacturing, used by the customer, and all the way to final disposal or recycling. And crucially, it includes all the environmental costs incurred at each stage.
A very holistic view.
Very. And finally, activity-based costing, ABC, can be a powerful tool. Just like it allocates overheads based on activities for regular costing, ABC can be used to allocate environmental costs to specific products, services, or activities based on the environmental impacts they cause or the activities undertaken to manage those impacts.
Using cost drivers related to environment.
Exactly. ABC helps to differentiate between, say, environment-related costs, which might be directly attributable to joint cost centers that have clear environmental consequences, like a wastewater treatment plant, and environment-driven costs, which are often those hidden costs buried within general overheads, but are ultimately driven by environmental factors or regulations, like extra compliance paperwork.
Okay, so various tools to get a handle on identifying and allocating these costs. Once they've been identified and allocated, how do organizations then go about controlling them? What are the strategies?
The methods for controlling environmental costs can vary. They can target specific environmental aspects or cost elements, like focusing just on reducing waste generation or cutting energy consumption, or they can be broader, organization-wide initiatives.
Right.
Often the most effective control methods are linked directly to the specific identification techniques that were used. If flow cost accounting showed huge material losses at one step, you focus control efforts there.
Makes sense. Target the problem areas.
And broader management philosophies like total quality management, TQM, with their inherent emphasis on continuous improvement, waste reduction, efficiency, and minimizing defects, often align very well with the objectives of environmental cost control. Aiming for goals like zero waste and zero pollution fits perfectly with both TQM and EMA.
Can you give some more specific examples of controlling costs by focusing on individual elements?
Sure. If you're focusing specifically on waste, using that mass balance approach from the input-output analysis helps you quantify how much waste is being generated. Then you can calculate the associated costs, landfill fees, emissions treatment costs, but also the cost of the valuable raw materials that were purchased but never made it into the final product. Knowing the true cost of waste provides a strong incentive to reduce it.
Right. Seeing the full cost. What about utilities?
For utilities like water and energy, sometimes it's as simple as implementing better monitoring systems, putting in water meters on specific processes, tracking energy use more closely. This data then allows you to target areas for improvement, like investing in more energy-efficient equipment or fixing water leaks. These often have very quick paybacks.
Simple but effective.
Often, yes. In areas like transport and travel, maybe transitioning to more fuel-efficient vehicles, optimizing delivery routes, or encouraging video conferencing instead of travel can reduce fuel costs and emissions. For consumables and raw materials, even seemingly small changes like encouraging double-sided printing, refilling printer cartridges instead of buying new ones, or finding ways to reuse packing materials can add up to significant savings and reduced environmental impact over time.
Little things add up.
Okay.
So what role does environmental management accounting ultimately play in making strategic decisions related to products and processes? How does it influence bigger choices?
EMA provides much more accurate and complete information about the true costs of products and processes, specifically by taking those previously ignored or hidden environmental factors into account.
And what does that lead to?
Well, this more accurate cost information can lead to several important strategic shifts. It might result in more informed pricing decisions, maybe charging more for products with a higher environmental footprint. It could lead to a reevaluation of the profitability of different products or services. Some might look much less attractive once their full environmental costs are considered.
Uh-huh. Revealing the true profitability.
Exactly. This could even lead to a strategic decision to phase out certain less profitable and more environmentally damaging product lines altogether. More positively, it provides a strong impetus to redesign products or processes to be inherently more environmentally friendly and cost-effective right from the start.
Driving eco-design.
Precisely. And it can also highlight areas where simple improvements in operational efficiency and basic housekeeping, like better inventory management to reduce spoilage or improved maintenance to prevent leaks, can yield significant environmental and financial benefits. It connects environmental performance directly to operational excellence.
So what are some of the overall advantages, the big picture benefits that organizations can gain from implementing EM effectively?
Effective EMA can lead to several key strategic benefits. Firstly, it can potentially increase revenue. As customers become more environmentally conscious, demonstrating good environmental performance and offering greener products can attract customers, enhance brand loyalty, and sometimes even support premium pricing.
Top-line benefits.
Secondly, and perhaps more commonly emphasized, it can certainly drive significant cost reductions through improved resource efficiency, using less energy, water, materials, waste minimization, less disposal costs, less wasted material cost, and reduced compliance costs or fines.
Bottom line, benefits through efficiency.
Exactly. And thirdly, it can substantially enhance the organization's overall image and reputation as a responsible and sustainable business. This can be a major competitive advantage in attracting investors, retaining employees, and building trust with customers and communities.
Image and reputation, very important today. Are there any potential drawbacks or challenges associated with implementing EMA that companies should be aware of?
Yes, it's not without its challenges. Initially, there might be increased costs associated with setting up the necessary systems for identifying, tracking, and reporting environmental information. That takes time and resources.
The setup cost.
Right. There might also be increases in compliance costs if EMA reveals areas where the company wasn't meeting regulations, or costs associated with specific image improvement initiatives like publishing sustainability reports. It can also place an additional burden on top management to truly champion and oversee these initiatives effectively. It needs buy-in from the top.
Needs leadership commitment.
Definitely. And of course, it's important to remember that even with a good EMA system, the costs associated with major environmental failures like accidents, large-scale cleanup operations, or significant regulatory fines can still be very substantial and potentially devastating. EMA helps manage risk, but it doesn't eliminate it entirely.
That's a crucial point. The conclusion in our source material really underscores the complexity, doesn't it, of identifying and allocating these environmental costs. And it emphasizes that without good EMA practices, businesses can inadvertently make decisions that are just unsustainable in the long run.
Exactly right. If the environmental costs associated with business activities aren't properly understood and integrated into decision-making, it can easily lead to choices that look good on a traditional P&L in the short term, but are not only environmentally damaging, but also potentially economically detrimental to the organization down the line, perhaps through future liabilities, resource depletion, or reputational harm. It really highlights the need for proactive management of these issues, not just after-the-fact reporting or cleanup.
Well, that was a really insightful deep dive into target costing, the theory of constraints, and environmental management accounting. Fantastic overview. To kind of bring it all together now, what would you say are the core takeaways from each of these strategic cost management techniques?
Okay, summing up. Target costing provides a powerful market-driven approach to proactively manage costs right from the initial design phase of a product, ensuring that profitability is considered from the very beginning, working backward from the customer's willingness to pay.
Market-driven, proactive design focus. Got it.
The theory of constraints, TOC, offers a valuable framework for maximizing the throughput, the money-making potential of your operations by identifying and relentlessly focusing your improvement efforts on the critical bottlenecks that are limiting your overall system performance.
Find the bottleneck, manage the bottleneck, increase flow.
Right. And environmental management accounting, EMA, is increasingly essential for understanding and effectively controlling the environmental costs associated with your business activities. Doing this well not only contributes to a healthier bottom line through resource efficiency and risk reduction, but also supports long-term business sustainability and builds a positive corporate image in an increasingly eco-aware world.
Understand and manage environmental impact for financial and sustainable benefits. Excellent summaries. So it seems each of these techniques offers a distinct yet valuable perspective for businesses striving to optimize their cost structures and enhance their profitability in today's really competitive and environmentally conscious marketplace.
Absolutely. There are different tools for different, though sometimes overlapping challenges. We really encourage you, the listener, to consider which of these approaches might hold the most relevance for your own situation or areas of interest, and perhaps to explore them in greater detail based on what we've discussed.
Great advice. And on that note, here's a final thought for you to ponder. How can a deeper understanding of these sophisticated cost management techniques, thinking backwards from the market, focusing relentlessly on constraints, and truly accounting for environmental impacts, how can that empower you to make more strategic, more profitable, and ultimately more sustainable decisions in your own professional life or business? Thanks for joining us for this deep dive.